Did you see the US stock market last week? The Nasdaq rose 0.5% while the Dow fell 0.5%. The news was buzzing about Amazon signing a $38 billion contract with OpenAI, but manufacturing indicators have been scraping the bottom for 8 months straight. What's more important is that the Dow fell. This signals that traditional industrial stocks are collapsing while only a handful of tech stocks are surviving. Amazon's stock jumped 4%. The cloud service contract with OpenAI is worth $38 billion, driven by expectations of accelerated AWS growth. Amazon CEO Andy Jassy said the shopping chatbot would generate an additional $10 billion in annual revenue. According to Bloomberg data, major tech companies including Amazon plan to increase AI technology capital expenditures by 34% over the next 12 months to about $440 billion. With $85.4 billion in contracts announced in just 1 week, 19.4% of the total plan has materialized. Nvidia also rose 2.17%. This was due to news of receiving export approval for GPUs to the UAE, and Microsoft also announced plans to invest $15.2 billion in the UAE. Microsoft President Brad Smith said they received approval after meeting all of the U.S. government's strict cybersecurity and physical security requirements. And this is really the crucial point. President Trump stated in a CBS interview that he will not allow exports of Nvidia's latest chips to China. But the UAE received approval, meaning the Middle East has gained trusted partner status in the US AI ecosystem. Microsoft can now expand its AI computing capacity in the UAE by 4 times and will invest an additional $7.9 billion by 2029. But here's the shocking part. Meta announced plans to expand AI investment, but its stock plummeted 11%. This happened in just 1 day on the 30th of last week. Kevin Gordon, director of macro strategy at Charles Schwab, evaluated this as the first case where increased AI infrastructure investment did not receive unconditional welcome. Meta said it would finance some investments with debt, but there was no concrete answer on how Meta, which has no cloud business, would make money from AI. Ellen Bond, managing director at Jensen Investment, also mentioned that investors have started checking spending discipline. Investor attention has completely shifted from how much you spend on AI to how much you earn from that money. What's the difference between Amazon and Meta? Amazon presented specific numbers: $10 billion in annual revenue from shopping chatbots. AWS cloud revenue also increased 34% to $15.2 billion, exceeding analyst estimates. There was a clear picture. AI investment increased cloud revenue, additional chatbot revenue. In contrast, Meta only had a plan to invest more in AI, with no answer on how to recoup that money. Especially since it has no cloud business. A company called Iron also caught attention. Its stock jumped 11.5% after signing a $9.7 billion AI cloud contract with Microsoft. It will provide cloud services using NVIDIA's GB300 architecture GPUs for 5 years, receiving 20% of the contract as an advance payment. Iron was originally a Bitcoin mining company that transitioned to an AI infrastructure company. It plans to build a 750 megawatts data center in Childress, Texas, providing core IT capacity with a high-performance design featuring water cooling systems. When the contract is fully implemented, it will generate approximately $1.94 billion in annual revenue. The transition from Bitcoin mining to AI cloud represents a successful case of business model transformation with an actual large-scale contract. AMD also has good earnings prospects. UBS analyst Timothy Arcuri estimates AMD's Q4 guidance will be $9.3 billion, about $200 million higher than market expectations. It could reach up to $9.5 billion. Both server and client CPUs are showing strength, with data center GPU revenue estimated at about $1.7 billion. Server upgrade demand is resuming, And as companies push to expand AI processing capabilities, AI investment is spreading to the traditional CPU market. This signals that NVIDIA's monopoly is gradually weakening. Alphabet also made moves. It announced plans to issue $22.5 billion in corporate bonds, raising $15 billion in the US and €6.5 billion in Europe. The bonds will be divided into up to 8 tranches, with maturities ranging from 3 years to 50 years, and demand for dollar bonds exceeded $90 billion, more than 5 times the issuance amount. Alphabet's capital expenditures this year are expected to reach $91-93 billion. Google Cloud revenue increased about 34% to $15.2 billion, exceeding analyst estimates, and Q3 revenue from products built on generative AI models increased more than 3 times year over year. But the economic indicators are serious. The ISM manufacturing PMI recorded 48.7, falling short of the expected 49.5. The baseline is 50, and it has fallen below it for 8 consecutive months. The employment index also rose by 0.7 points to 46.0, but remains weak, and the deteriorating business environment for manufacturers due to tariff policy uncertainty continues. The U.S. federal government shutdown is also continuing for the 34th day, increasing economic uncertainty. Manufacturing has been scraping the bottom for 8 months. The government has been closed for over a month, yet the Nasdaq rose 0.5%. But the Dow fell 0.5%. What this means is that tech stocks and the rest of the market are operating completely separately. Kimberly-Clark announced it would acquire Kenvue for $48.7 billion, but its stock plummeted 14.57%. The acquisition is a cash-in stock mix at $21.01 per share, reflecting a 46% premium over Kenvue's previous closing price. After the merger, Kimberly-Clark shareholders will own 54% and Kenvue shareholders 46%, with combined annual revenue expected to reach about $32 billion. Huggies and Kleenex will be under the same roof as Tylenol and Listerine, but investors responded coldly due to financial burden concerns. In contrast, Kenvue's stock rose 15.45%. This shows growing skepticism about large-scale M&A in traditional industries. Beyond Meat announced it would delay its Q3 earnings announcement, and its stock plummeted 8%. The reason was delayed calculation of non-cash impairment losses, and investors expressed concerns about the earnings delay. Companies not related to AI are really facing a survival crisis. Here's one more important thing. It's about the bond market, and this is something many people misunderstand. The U.S. 10-year Treasury yield is 4.11%. People say it rose slightly, but this is actually still very high. Although the probability of a rate cut in December has risen to 67.3% in the federal funds rate futures market, a 10-year yield in the 4% range is still a significant burden for companies and the government. The Treasury announced its Q4 funding plan, issuing a record $1.058 trillion in net Treasury securities in Q3. The Q4 net issuance plan was slightly adjusted down to $569 billion, a decrease of $21 billion from the original expectation of $590 billion. But here's what you shouldn't mistake: the number $569 billion isn't small. Issuing this much in one quarter is still a massive amount. Looking annually, Treasury net issuance has been declining since the pandemic. After recording $4.281 trillion in 2020, it decreased, then rose again to $3.1 trillion in 2023, then fell to $2.364 trillion last year, and is expected to further decrease to $2.061 trillion this year. The $303 billion year-over-year decrease is true, but this doesn't mean the problem is solved. Still, having to issue over $2 trillion in Treasury securities annually means the burden remains large. Tariff revenue is contributing significantly. Tariff revenue in fiscal year 2025 recorded $194.9 billion, a threefold increase from fiscal year 2024's $77 billion. Since April, when the Trump administration's tariff policy began in earnest, monthly average tariff revenue has been $27.1 billion. If this trend continues, annual tariff revenue is expected to reach about $300 billion. While this alleviates the Treasury issuance burden, it hasn't resolved it. The need to issue over $500 billion each quarter remains. There was also the Fed's QT termination. Last week, the FOMC announced it would end quantitative tightening QT starting in December, allowing the Fed's holdings of mortgage-backed securities (MBS) to naturally decrease by not reinvesting when they mature or are prepaid. But they said they would fully reinvest the amounts repaid from MBS into Treasury securities. Over the past 12 months, MBS in the Fed's balance sheet decreased by an average of $16.3 billion per month, which now creates about $16 billion in monthly demand for Treasury bills. This does help the Treasury market, but it's not a fundamental solution. It should be seen as a short-term buffer. Stablecoins are also increasing Treasury demand. The Genius Act, which passed on June 19 and requires 11 reserve holdings, including U.S. Treasury securities when issuing dollar stablecoins, led to an increase of about $50 billion in outstanding dollar stablecoins. As Tether, which occupies 23% of the dollar stablecoin market, increases its U.S. Treasury reserve holdings, stablecoin issuers' demand for U.S. ultra-short-term Treasury securities will increase further. The Treasury said it would increase Treasury bill issuance. In the quarterly funding plan announced on July 31, it said it would maintain coupon issuance over the next several quarters but increase Treasury bill issuance. Treasury bills have maturities of less than 1 year, so they have almost no term premium and are heavily influenced by the policy rate. This is fine as a short-term funding strategy, but it doesn't solve long-term fiscal health issues. South Korea also secured a large amount of GPUs from NVIDIA. The government and companies agreed to secure a total of 260,000 units by 2030, which is a total of 300,000 units including the existing 40,000 units. This is the third largest scale in the world after the US and China. The goals include fostering the national hyperscale AI model industry, developing customized AI services for companies, expanding into industrial intelligence fields such as manufacturing, healthcare, and logistics, and creating an open ecosystem for research and service development using GPUs in schools, research institutes, startups, and public institutions. There was also an easing of maritime tensions between the US and China. The U.S. announced it would suspend collection of port fees for China-linked vessels for 1 year, starting November 10, evaluated as a measure to ease maritime tensions that were a point of contention in the trade war. Let me summarize. The market is in a really dangerous state right now. The Nasdaq rose 0.5% but the Dow fell 0.5%. The S&P 500 only managed to rise 0.2%. What this means is that a handful of tech stocks are forcibly propping up the indices, but the overall market is collapsing. Manufacturing has been contracting for 8 months. The government shutdown is at day 34. The 10-year yield remains elevated at 4.11%, yet only a few companies like Amazon and NVIDIA are rising on large AI contract news. The key here is that AI investments are now evaluated by whether contracts are signed, and clarity of monetization paths. Amazon presented specific revenue targets $10 billion from shopping chatbots, and Iron actually secured a $9.7 billion contract. Meta only had investment plans and couldn't explain how it would make money. The results were directly reflected in stock prices: Amazon 4%, Iron 11.5%, Meta minus 11%. Kimberly-Clark's 14.57% plunge after the Canview acquisition announcement and beyond. Meets 8% drop after delaying earnings show how difficult the situation is for traditional industries and non-AI companies. The UAE is emerging as a new hub in the US AI ecosystem. South Korea has become a top 3 GPU holder, and AMD's upward Q4 guidance revision signals that Nvidia's monopoly is gradually weakening. The Treasury market is not stabilizing, but rather preventing further deterioration. The 10-year yield at 4.11% remains a burdensome level, and the situation of needing to issue over $500 billion each quarter hasn't changed. While monthly tariff revenue increasing to $27.1 billion and the Fed reinvesting MBS redemptions into Treasury securities helps, these aren't fundamental solutions. Increasing the proportion of Treasury bill issuance is only a short-term funding strategy. Ultimately, the market is now completely split into AI tech stocks and everything else. And even among AI tech stocks, only the very few with actual contracts clear monetization paths are surviving. Economic indicators are collapsing, the Treasury yield burden remains high, and the Dow is falling. While only the Nasdaq rises, we really need to watch how long this situation can continue. Signals are emerging everywhere that relying on just a few tech stocks in this polarized market state is dangerous.